All right, let's get in the trenches with some safety stocks. Evan, the typical safety stock, the dividends, the, boring stocks like the utilities. I mean, last week the NYSE traders that caught to a few were all saying utilities are getting bought. That's all anybody wants. But we wanted to highlight a different kind of trade, and that would be the agricultural stocks. Probably not one you associate with safety, but a lot of them do have dividends, and we were seeing some inflows yesterday. What do you think about that sector as a whole before we get to some specific names?
It's a sector that hasn't really performed over the last year and a half, as the market really has built a nice rally over the last year and change. We haven't seen a lot of money get pumped into that sector. On the short-term perspective, things are starting to develop and starting to look a little bit better. So they do present an interesting scenario right now.
Because we do have high corn prices, of course. High commodity costs in general can be a negative as input costs rise. But a lot of these guys have big exposure to Latin America, which is a huge growth area and doesn't have the kind of headline risk, of course, that Europe and U.S. have and that China has. So we wanted to highlight some names for you. The first one is CF. It's one of the leaders, one of the top 20 performing S&P stocks of the year. It's like $8 away from its 52-week highs. Can it get there? And should investors kind of be using pullbacks as buying opportunities?
I definitely think so. The market's telling us right here. You could see through August, as the market sold off very aggressively in August. Yeah. CF, nice rally here, off the 140 up to 200 in just literally a month. Nice little pullback here. I would wait for a little bit more basing action before I throw some money in there. I do want to see it kind of build a base before we launch higher, but it looks to me like the stock wants higher.
And it does have a dividend, almost 1%, and exposure to Brazil. Brazil expanded 3.1% in the second quarter. That's not too shabby.
Not at all.
Considering our growth in the U.S. All right, let's go to potash. It's usually, the high-end, the sexy fertilizer, the more expensive one. Does this stock show the same kind of momentum as CF?
Not necessarily. Let's take a look at the weekly here. I think it tells the story of potash. We have been in a range, and it's clearly defined here for the better part of 2011. We found support at 50. We found resistance in the mid-60s. I really probably wouldn't do anything until I clearly see a breakout. Even though you might be chasing it up a little bit, wait for the breakout, because right now it does tell me it wants higher. This is a very bullish type of price action.
And not yet.
You could probably dip your toes in a little bit here and become a little bit more aggressive on a breakout. But it looks to me like above these prior highs here in the low to mid 60s, we could see higher prices.
And let's go to Monsanto, because it's been a very unloved stock in this area. It has a 1.8% dividend, down about 1.5% on Tuesday. It does have some headline risk. Basically, it's corn infected. It's corn's getting infected, basically. So it's resistant, and I'm like stuttering. I can't even talk right now.
It's okay.
The pesticides are not working like they thought, and so their corn is toppling, and that could be a big deal, and the stock's gotten hit. But if they can get their act together and really transition into corn versus chemical, do you think that they have an upside here?
Well, it's definitely not the leader. It's clear here. It's on the lower end of the range, while some of the other stocks in the sector are flirting with breaking out. We obviously looked at CF. CF was making new highs.
Right.
On the lower end of the range, but very much like potash in the sense that it's been range-bound for the better part of this year. We are now 9 months into the year. This is a 9-month base. If it can start to show some rally legs here, again, you have a little bit of risk, the least amount of risk being a buyer here on the lower end of the range. So you could dip your toes in here for a trade, but below $60, I'd probably get out of Dodge.
And it does have a dividend, almost on par with the yield in the 10 years. So something to think about. All right, let's round it out here with Deere. It has a juicy 2.1% dividend, was down just over 1% on Tuesday. So, Stephanie Link, Director of Research at The Street, really likes this story. And the idea is that as farmers make more money off of high corn prices, they're going to get fertilizer and they're going to replace their equipment. They're going to get better equipment, and that's a Deere story.
Well, let's take a look here at John Deere technically. Stock was a great performing stock for the better part of this year. It's come off substantially from just about $100 to current levels at 75. This to me tells me it's not quite ready to rally yet. A little bit of a bear flag. We might see a retest to that 65 level. If we can turn up and get above this little peak high right here in the mid 80s, I think John Deere would be a little bit of a safer trade.
And it doesn't have a lot of exposure to Europe and a lot to Latin America, so something to keep in your back pocket.